Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include winning business regardless of the direction of rates, my interview with ABL's Kevin Rodman on how hard money lending has evolved and why private capital is gaining ground in today's high-rate, high-stakes real estate environment, and what would we talk about without the Fed? Thank you to Wholesale Mortgage Direct for sponsoring today's podcast. Their mission is to deliver high-demand, innovative products unique to the wholesale industry, including My EQ Now, which is a one-of-a-kind traditional HELOC platform. Looking for innovative HELOC, non-QM, and or reverse options? WMD is your trusted partner. Everyone out there is striving for business regardless of the direction of interest rates. Morgan Stanley, for one, doesn't see any Fed rate cuts until 2026. LOs can depend on interest rates for their livelihood. Ongoing subdued mortgage originations are forcing mortgage brokers and MLOs in general to move beyond just agency originations to other loan products such as non-QM, home equity, and investor financing. Such alternative offerings provide a lifeline to additional income avenues for originators. And yes, markets may be pricing in less than a 5% likelihood of a rate cut on July 30th, but that hasn't kept investors from working out how to position themselves, just in case President Trump does fire Fed Chair Powell. Spoiler alert, it's unlikely, for a variety of reasons that this podcast has previously outlined. The independence of the central bank was a key theme last week after a media report that Trump was likely to fire Powell soon. Trump eventually walked back the speculation. Treasury yields stabilized following those Powell-related headlines, with markets now viewing the September FOMC meeting as the next potential opportunity for a rate cut. In more worthwhile news, we learned last week that key inflation readings in the core consumer price index and core producer price index for June came in softer than expected, shushing worries that President Trump's trade war would have a big impact on prices. Moreover, June retail sales blew past estimates. With the impact of recent tariffs yet to fully materialize in the data, upcoming data will be pivotal in shaping the Fed's next steps. Friday's data showed a 4.6% rise in housing starts for June, alongside a modest 0.2% uptick in permits, largely driven by a rebound in multifamily construction. However, single-family starts declined and permits fell for the fourth consecutive month as high mortgage rates and home prices continue to suppress buyer demand and deter new single-family building, while affordability pressures are pushing more households toward rentals, fueling renewed momentum in the multifamily sector. For today's interview, I wanted to welcome to the show ABL's Kevin Rodman to talk about how hard money lending has evolved and why private capital is gaining ground in today's high-rate, high-stakes real estate market. He's the CEO of Asset-Based Lending, driving the company's culture, strategy, business plan, and execution. With over 40 years of experience in the mortgage industry, his leadership has guided ABL to become a nationally recognized private lender.
I want to start by talking about hard money lending. And as I said to you offline, it's neat to see some of these fringe products come back toward prominence to cater to modern borrowers and that sort of thing. You have over 4 decades in private lending and real estate. How have you seen hard money lending evolve during that time, and where do you see it going from here, taking into account what I said about, it's come back into prominence a little bit?
Great question, Robbie. I spent 25 years on Wall Street, mostly at Morgan Stanley, and then 2 partners and I in 2010 after the Great Recession, really coming out of it, saw a real need for capital to be brought to real estate because there were so many distressed properties that needed to be bought and renovated and recycled. So my partners and I entered the market back then, and honestly, it was a cottage industry. There were small companies all over the place, usually with family money. There were no real big lenders, and certainly no national lenders. And we put out a shingle, and we built a business. And fast forward to about 2017, 2018, and Wall Street discovered the hard money lending space. And what I mean by that is some of the biggest firms in the industry found out that we were making loans at all in 15% and never losing money, which for me, being an old bond guy, never happens, and for a sustained period of time. And now here we are 15 years later, and we've still hardly lost any money. And so what happened is Wall Street came in and they said, "Hey, we want to buy these loans." And by bringing that capital into the system, it completely changed the market. And what I mean by that is that it allowed, instead for little companies like ours, we had 100 million of capital at the time. There was a fund of friends and family. Um, it allowed for dozens and dozens of companies to lend money and sell their loans to Wall Street. So the market became much more competitive. And then Wall Street started pumping money into companies to make them big and national. And so now, over the last 7 or 8 years, the entire industry has changed. We've gone from mom and pop cottage industry, where there were local lenders lending in areas they knew, to an industry that's starting to consolidate. It's still somewhat fragmented, but there's clear winners, winners and and I don't want to say losers. Everyone's a winner. Anyone that's in this space has carved out a niche and is succeeding. But there's clear major winners. There's companies doing many billions, and most of them are backed by a Wall Street firm. And so the market become much more institutionalized, much more competitive. Um, Things are becoming more standardized than they were 15 years ago. And I think that trend's going to continue.
Well, aside from being backed by a Wall Street firm, are there strategic changes going on or innovations that you're seeing these winners, quote unquote, take? Like I alluded to at the start, there's obviously, a huge subset of potential borrowers out there that, this caters to, and there's demand, certainly.
Yeah, there's a lot of capital has flown into our industry, and it has allowed our industry to greatly broaden the number and type of borrowers that we're lending to, and to really change the product mix. The biggest change is new construction. So when we started 15 years ago, hard money lenders never did new construction. That the banks owned that product. But the banks got out of it in the great financial crisis. They really exited the space. And so that opened up a big gap for us to enter. My company, ABL, entered in 2015. Now we're doing many, many hundreds of millions a year in new construction, and other firms in the hard money space are doing it too. And then the second big innovation and product that hard money lenders have gotten into are 30-year debt service coverage ratio loans for investors that buy properties and want to hold them. And that's completely new in the last 5 or 6 years. It's become a really big business now, the DSCR product.
Especially in this higher rate environment, traditional financing gets a little constrained. So I'm hoping you can explain the competitive edge that private lenders in general, and yes, ABL included, offer borrowers. I've heard tales of beating out banks in certain scenarios, which is pretty cool.
Well, the first thing we bring is speed. It's all about speed. So it was particularly the speed was even more important when the excess inventory from foreclosures was still being auctioned off from 2010 to 2016, after the great financial crisis, because borrowers would go to an auction and win a bid and have to fund in 24 hours. And we would issue term sheets and fund. And so it's, what I like to say is, yes, we're a money lender, but the most important thing we do is speed of money. We're a speed of money lender. And what I mean by that is, if a borrower comes to us and says, I have to close this in 5 days, we have a hard stop, I have a hard deposit down. We look at the deal, we underwrite it within 2 hours. Everything is speed. We say, we like the deal, we're in. we're going to close that loan in 5 days every time. And then you move on to the draw phase of the project, whether it's a fix and flip or new construction. And that's where innovation is really taken off in the last 2 or 3 years. So 15 years ago, and even up to 3 years ago, and still a lot of firms, most firms do it the old way, which is send an inspector. Borrower says, I need a draw. They can do it on the portal, or they can call in or email. We say, okay, we'll send an inspector. Inspector calls to make an appointment. It's like 20th century stuff. It's old school. Um, you know, inspector comes out there, photographs, checks off a bunch of things that's done, makes a report, sends it back. It's like 5 days are gone. Well, now we have technology that's available to other firms. I don't know how many of them are using it, where our borrowers have an app on their phones, and 90% of our borrowers use it. And they've uploaded their draw schedules to the system. And they go to their project at 8 a.m. in the morning. They take a video of the entire project, outside and inside. We have to see everything. No matter how many times they're drawing, we want to see the whole project. And they have to focus in on where they want their draws. They upload it. We review it. We have 8 draw managers that review draws. We do over 500 draws a month. If we like what we see, we send them the money the same day. 5 years ago, a week. Today, 8 hours. And that technology is blockchain, and it's geo time-stamped and geolocated. So we can't be defrauded. We know it's the property. We can check it out on a map, and we know the time that it was made. And that's been the big innovation of what technology has brought to our space in terms of speed of money for draws. Lots of innovations too around getting loans closed too. And with AI, although I can't say it's revolutionized our business yet, I have no doubt within 2 years, we're going to see 2 to 3 day closings as normal. That's what AI is going to do for our industry.
It's very exciting, and I'm glad that you're on the blockchain because it seems like a perfect use case for mortgage. The provenance is there. You can get all the benefits you mentioned. Let me zoom out before I let you go, and high level view. You've been through so many market cycles in this industry. You understand the cyclical nature. What are you seeing right now? Obviously, there's an affordability crisis. Homes are still selling. Now sellers maybe aren't listing because prices are falling. We're moving away from rate. You're the expert though. What are you seeing out there? How do you kind of characterize the market?
Well, let me say first that it's a cliche, but it's true. All real estate is local. So ABL lends in 42 states, but really most of our business is in 10 states. We're very much a Northeast, East Coast lender. We all go all the way down Florida to Texas. We're in New Mexico, Colorado. We're not so big on the West Coast. That's just because we've been moving that direction and haven't gotten there yet. That's number one. Number two, we have another huge innovation that's happened in the last 3 or 4 years is there's an incredibly rich suite of tools available to us to evaluate the value of real estate by zip code. We can easily get down to by street. And what I mean by that is today, when a borrower brings us a loan, we can go into our data sources and look at how many homes are for sale at that price point in that zip code, and how long have they been on market. So there are some areas right now that are getting overbuilt, particularly in Florida. It's already in the newspapers. And we can find areas in Florida where a $400,000 home is actually still moving in 60 days. But $1 million home could take a year to sell the excess inventory. So we're really smart about the way when we underwrite. we look at every zip code by zip code. So what I can tell you is that the home price lack of affordability is a national tragedy. It's just a shame that 10 years ago, a first-time home buyer family was 32 years old. Today, they're 39 years old. It's not sustainable. Something's got to give. Our average home price at an ABL, we have over 1,300 homes in our book right now, is about $550,000. And it just is, it is what it is. And so something's got to give. So it's my general belief that there will be a number of areas in the country that see flat home prices. I hope they don't go down, but certainly there are some areas that we're seeing price declines. It's been well advertised that Austin got overbuilt, and at certain price points, prices have been coming down in Austin. The west coast of Florida, same thing. It's pretty public. Prices are coming down. However, ABL is big in Tennessee. There's a lot of areas of Tennessee where prices are still strong. We're probably the top lender in New Jersey, our home state. There's a shortage of housing here. Prices are great. So basically, to answer your question, there are always pockets of strength and there are always pockets of weakness. And what we've had over the last 15 years is an extraordinary bull market in real estate since the bottom of the great financial crisis. It's my belief that the affordability has gotten so unaffordable that we're probably hitting a peak. And whether prices go down or not is going to depend on what happens on interest rates, happens to the economy, happens to wages. Wages have to keep going up to afford these higher price homes. But I think what you're going to see is a mixed bag across the country. I think you're going to see pockets that remain somewhat strong, pockets that now start to go down a little bit. But there's one thing for sure, which is the millennial generation is a unstoppable force of home buying. They're still, at least varies between 3 to 5 million homes that the millennial generation is going to want to buy. And from our experience so far, what we're seeing is they love new homes. And there's a shortage of developable land available for development. So once we get through this price problem, the general thesis is absolutely here. We're card carrying believers in it at ABL. We believe the millennials are going to drive home formation, household formation, and home buying for the next 5 to 8 years, in addition to the baby boomers retiring from the North and California and moving to less expensive areas. So overall, we're bullish on housing demand, although in the short term right now, we're very concerned about prices flattening out and in a lot of areas because of the lack of affordability.
Very sage advice. It really is a mixed bag, and I appreciate you saying that. I was just in Chattanooga, Tennessee. I can vouch for it. It's up and coming. It's like the Portland of the East, hipsters here and there. Yeah, so there's good stuff out there at reasonable price points. I mean this sincerely when I say this. I wish you the best of luck. It's really neat what you're doing. I thoroughly enjoyed this, so thank you very much.
Thank you. I really appreciate the time. Great seeing you.
This week's data is less of the higher tier, as is usually the case for the third full week of the month. Data of note includes leading indicators, Fed surveys, PMI flashes, and housing data. The Fed is in blackout ahead of next week's FOMC meeting, but Chair Powell and Fed Vice Chair for Supervision Bowman will appear at a Fed conference on the regulatory capital framework for large banks tomorrow. Outside of the Fed, the ECB will be out with its latest monetary policy decision on Thursday morning, where the expectation is to hold rates steady. For MBS, Class D 48 hours is tomorrow, and equity earnings releases continue. June leading indicators kick off today's calendar later this morning. We begin the week with agency MBS prices better than Friday's close by 1/8 to 1/4, the 2-year yielding 3.84. and the 10-year yielding 4.37 after closing last week at 4.43%. Let's wrap up with a joke and some housekeeping. My cousin told me that he wants to study borrowing rodents. Borrowing rodents? I told him, go for it. What's a borrowing rodent? What's a borrowing rodent? Oh. Burrowing? Burrowing. My cousin told me that he wants to study burrowing rodents. I told him to go for it. Thanks again to Wholesale Mortgage Direct, whose mission is to deliver high-demand, innovative products unique to the wholesale industry, including My EQ Now, which is a one-of-a-kind traditional HELOC platform. WMD is your trusted partner for innovative HELOC, non-QM, and or reverse options.